Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: small trading or gig income might be covered by allowances depending on how you report it. A limited liability partnership, usually shortened to LLP, is a UK business structure that sits somewhere between a company and a traditional partnership. Legally, an LLP is a body corporate. That means it has its own legal identity, separate from the people who own it. It can own assets, enter into contracts, and take on debts in its own name. So in legal terms, it can feel company-like. But for tax purposes, an LLP is usually treated very differently, and that difference is the key to understanding how LLPs work. Even though an LLP is legally a corporate body, for tax purposes, it is normally tax transparent. Tax transparent means the LLP itself is not usually the taxpayer on trading profits. Instead, the profits are treated as arising directly to the members in the profit-sharing ratios agreed between them. This transparency is not just a matter of HMRC practice, it is built into the tax legislation. When tax rules refer to partnerships and partners, those rules generally apply to LLPs and their members as well. LLPs were introduced in the UK in 2000. They were originally designed for professional firms such as accountants and lawyers, allowing them to retain partnership flexibility while benefiting from limited liability similar to a company. Over time, LLPs became popular more widely because they combine legal separation and limited liability with flexible profit-sharing arrangements. An LLP does not have shareholders, it has members. Members are the owners of the LLP and are broadly comparable to partners. Although liability is usually limited, that does not mean members face no risk in all circumstances, particularly where guarantees or specific obligations exist. LLPs must be registered at Companies House and have ongoing compliance obligations. These typically include preparing accounts, filing accounts and confirmation statements, maintaining registers, and identifying people with significant control. When an LLP is tax transparent, it calculates its profits and allocates them to members. Members then pay tax on their share of profits. If the member is an individual, the profit share is taxed under the income tax system and may involve national insurance. If the member is a company, that company is taxed under the corporation tax system on its share. This means the same LLP can allocate profits to both individuals and companies, with different tax treatments applying at member level. Because an LLP is transparent, it cannot claim or surrender group relief. Group relief is a corporate concept and applies between companies taxed in their own right. LLP losses are therefore dealt with at member level and are subject to specific restrictions. Transparency is not automatic in all cases. A key requirement is that the LLP must be carrying on a business with a view to profit. If there is no genuine profit motive, transparency can fall away and the LLP may instead be taxed as an entity. Transparency can also be affected during winding up situations. However, transparency may continue where a trade has only temporarily ceased, or where the LLP is being wound up in an orderly way without unreasonable delay and not for tax avoidance purposes. A specific practical risk exists for LLPs with only 2 members. If one member dies, a replacement normally needs to be appointed within a limited period, often described as 6 months. If that does not happen, legal and tax consequences can follow, including risks to transparency. There are also special anti-avoidance rules for certain investment and property investment LLPs. Where members include certain tax-exempt bodies, such as pension funds or specific insurance businesses, transparency can be switched off, and tax can arise at LLP level instead. Loss relief for LLP members is restricted. Relief can be limited by the member's capital contribution and economic risk. There is also an annual cap of £25,000 on losses that can be allocated to certain non-active individual members, as at September 2025. Another important feature is the salaried members rules. In some cases, an LLP member is taxed as an employee rather than as a partner, which can trigger PAYE and employer national insurance. In summary, An LLP is legally a corporate body, but is usually taxed like a partnership. Members are taxed on their profit shares. Individuals and companies are taxed differently. Group relief does not apply. Transparency can be lost in certain situations, and loss relief is restricted. And this brings us back to the fact we opened with. Small trading or gig income might be covered by allowances, but it depends on how it is reported and who it is taxed on. LLPs show why that distinction matters, because tax usually sits with the members, not the LLP itself. Why don't accountants tell secrets on a full moon? Because the taxman might hear the howls.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.